Coffee with Rob. We need some coffee. Always good. Always good. Keeps me going. And just remember, this is a lagging indicator. So by the time you take this trade, I'm going to show you the best way to trade with the MACD. Then you decide what your risk factor is per trade. Now, in my case, I always recommend a 1% risk per trade. So for every single trade that you take on a $100,000 account, the risk would be $1,000, not $1,000. That's your risk. You guys know I don't trade with indicators. I normally use price action, support and resistance, but I'm doing a little series here for you guys on how to trade with specific indicators, just so that you guys can get an idea of how to trade with these different things that are in the market that other guys are using, because it's always good to know what you're doing. And some of you might actually be trading with these indicators and not doing it correctly, or not understanding exactly how to trade with them. Somewhere in the last 30 years of trading, I've traded with the MACD. It's known as the moving average convergence divergence. It's a fantastic little product to use, and you can also throw it in with your support and resistance if you want to, and your price action. I don't, because it just takes up space on the chart and I don't need it. I don't need other indicators to give me confidence as to what I'm doing. As I've told you before, the market's a 50-50 game. Trading is risky. 60 to 80% of traders do lose money trading on day trading or normal 4-hour charts and that sort of thing. Position trading, there's a good chance that you could lose money as well. So if you don't like risk and you don't like losing money, hey, don't trade. That's probably better. If you're trading 5-minute charts and you think you're a day trader and you're so good at this, let me let you know that 99% of traders lose money there. So that's even worse. Just thought I'd throw that in so that you know about it. That's better that you know than when it happens to you. At least you understand why. It wasn't you. At the end of the day, it was just that it's a tricky thing to play with. The moving average convergence divergence is a fun thing to trade with. I'm going to show you how to trade with that. And then after I've shown you how to trade with that, we'll go to the strategy that we use to trade with after the charts. We'll go to the charts. I'll show you how to trade it. I'm not going to show you our price action system and our support and resistance system that we use on a regular basis. If you want that, go to one of my previous videos. It's in most of the videos because that's all we trade with. But if you want to know how to trade the MACD, then stick around. I'm going to take you to the charts. I'm going to show you that. And if you want to know a strategy that'll make you money in the market, a strategy that will turn you into a winning trader, because it's all about your mind, it's all about the psychology, it's all about the fear, then stick around for that, because after the video, after the charts, I'm going to show you exactly how you can trade in such a way that you get your mind bending around it, you get your mind sorted out, so you can actually start making money. So you can actually start making a profit in the markets and stop worrying about squiggly lines and win rates and that sort of thing. Let's rather start making you a little bit of money there, and then you can really get ahead instead of all this other stuff that you've been learning. I don't know, maybe you paid for a course, maybe you paid thousands of dollars for it. I don't know, let me know in the comments what you paid for your course, and you've come back and you're all excited and you know everything about the markets and you know all the systems and you know how to trade and you've got all the abbreviations in your head. Hang on, it's coffee with Rob. Let's have some coffee. Always good. Now you think you know everything about the stock market, you know everything about Forex trading, you know everything about commodity trading, and some expect you to trade with only one product or to trade this 5-minute chart, and you've done it on a demo. You've done it on a demo and you've succeeded because that's easy. Because all that is systems. That's a bit like going to school and learning how to add 1 + 1. So now you've learned that, now you're all successful. And now you come back and you get on your computer and you're like, we're gonna trade now. And you know what? You put real money in the market. You suddenly put real money in the market, and guess what happens? All those fear receptors in your mind, all that little, there's something in your brain that changes, it like changes gear. Suddenly everything becomes immensely difficult. Suddenly everything changes for you, and it's no longer what it was when you were sitting on that course with a little instructor in the front and the little people sitting next to you also paying thousands of dollars, and you've listened to everything they've said, and now suddenly you've got real money in the market and the sweat's on your brow and you're thinking, why am I struggling with this? That's because they never taught you and they never told you that it's not about the squiggly lines, that it's not about the system and the win rate and all that rubbish. It's all about you, the trader. It's all about how you approach the market, and it's all about your state of mind. How much are you trading? Are you trading too much? Because if you're trading too much, if you're trading beyond your means, you're not going to sleep at night and you're going to struggle. Your heart's going to beat faster. You're not going to be able to take it. But in all honesty, guys, if it's your first time in the markets and you haven't really put money in before and you haven't really gambled or anything before, I'm not saying that trading's gambling. Don't get me wrong. That's not even close. Trading is a career, but risking money has the same concept, right? You're risking money. So if you haven't risked money like that before, then suddenly your heart will start beating faster, even if it's $1, because suddenly you're losing it, and that can be quite stressful. So to become a good trader, you've actually got to become a good loser. Yep, really. You've got to become a good loser, not just a good winner. Being a winner, well, if you win, that's easy. Well, actually not. It can be quite difficult, as I'll explain to you after the charts. But being a loser can be really, really tough when it's your real money. Anyway, let's go and show you how to trade MACD. So what's MACD? Before we get started, it consists of 4 components, right? The first component is your MACD line. There's a line that goes up. It's like a moving average. The second component is your signal line. The signal line crosses over your MACD line on a regular basis, and that's what makes up the market. And then, of course, you've got your histogram. The histogram is the distance between those lines, and as it grows, it gets bigger and it gets smaller. You'll see on the charts. And then, of course, you've got your zero line, the middle of the indicator. It's an indicator that sits at the bottom of the chart. It works a lot like the moving average crossover system, which I showed you in the last video. And just for those who are interested, have a look, see how it works. It's always good to know how these things work. Don't use too many indicators on your chart. Don't change your system every 5 minutes, guys. Stick to the price action, stick to the support and resistance. But if there is an indicator that you could use in confluence with the price action system, the MACD is one of them, because it will help you with overbought, oversold scenarios. And it'll also, if you have identified a specific trend with your price action, you can actually work with the MACD to get into your trades. But bear in mind, the MACD is a lagging indicator. So if you get into the trade based on that, you are going to get into the trade too late, and you are going to get out of the trade too late. You will be leaving money on the table. But it's an indicator. It works like all the indicators work. As I've told you before, all of the systems work. All of the indicators work. The factor in the market that makes it an 80% loss game is the traders. It's got nothing to do with the squiggly lines, the systems, the indicators. It's all about the traders. The traders are the ones that are losing. End of the day. Let's go to the charts, guys. Let's go and see how the system works, and then we'll come back and we'll talk about how you approach the markets. We're going to show you how to trade with the MACD. Now, you guys know that we normally trade with nothing. Normally, we just have the chart, we put the support and resistance in, we take it from the day chart, we get our information, and that's how we trade. We don't use indicators. But I'm doing a series at the moment showing you guys how to trade with the different indicators, particularly over this period. And it's interesting. It's always good for you to know what's going on in the market. So today we're doing the MACD, the moving average convergence divergence. Okay, just type in MACD, close that. We go up there. Obviously, it's got to be on my system, and it's not there. Right, there we go. MACD. That's what it looks like, guys. So effectively what you get is 4 components. I'm making it bigger so that you can see it, right? Normally I don't like them on my chart, even at that size, because it takes up space on the chart. But I'm just making it a little bit bigger so we can see what we've got here. So there's our chart, there's our MACD. Now you get 4 components. The first one is the MACD line, which would be this line up here. And that line would normally be the equivalent of a 12-day moving average. You can change it. It can be 926 like we did. Like the last video where we did the moving average crossover, this is very similar and it's very easy to follow. The second line is your signal line, which would be this brown one here. And that would normally be based on, say, a 26-day moving average on the MACD. And then you get your histogram, which is these big green bars and these big red bars down here, which tend to move in and out. And you'll notice that when the line crosses, when the MACD line crosses the signal line, this green bar starts to move up and it starts to grow. Then you get your zero line, which these histograms tend to lie on or rely on, because you've got your price above the zero line, your price below the zero line. So obviously bullish and bearish, pretty straightforward, right? So that's your MACD in a nutshell. But these areas that grow here on the histogram, what they actually depict is the distance or the size between these two lines, between the MACD line and the signal line, the growth between them. So the further out that goes, the further apart those two lines are, which in general, I mean, if you look at that, you get this overbought, oversold signal in your mind, because it's getting to those levels, and you can start to work out what those levels are on any given chart. This is not what we trade with though. Now what you have to bear in mind with the MACD is, if you're trading, try not to trade against the trend, because it is possible to do that in an MACD scenario, because the basic principle of trading with the MACD is, when the MACD line crosses the signal line, at that point, that would signal for you to take a long trade, as long as the signal line and the MACD line is below the zero line. That would be a long trade. And if it's at the top, above the zero line, and it crosses down, the MACD crosses the signal line over there, you can see where it's crossing, then at that point, it would indicate a short trade. But with this, if you're trading with this, and just remember, this is a lagging indicator. So by the time you take this trade, the trade should have been taken long ago. But okay, let's ignore that. And let's say you want to take a short trade right at this point here. In a scenario where the US 500, this is the US 500, is extremely bullish, but you want to take a short trade. So just think about this. You are now trading against the trend, and you don't actually want to do that. So what I would recommend is, if you are going to use the MACD at all, in any way, shape or form, identify the trend with your price action, which you've already learned from me, and you can go back on all the videos with, it's all in there, because that's what only thing we trade, and we're going to go back to pushing it in over and over and over again, because that's the only thing we trade with, price action. So you already know how to operate with price action. I've already showed you that. So just go back and just check, okay, this is a bullish trend. There is a bit of a bubble here, but this is a very bullish trend. That is extremely bullish. You don't want to be trading this short, because you're counter trading against the trend, and you just don't want to be doing that. So what you do is ignore those signals. You only take the signals on the long side, because this is a full-on bullish product. So you would have taken the long trade when it crossed there. And when it gets wide, when this becomes extremely wide, and you're thinking, oh, that's overbought, then what you can do is start looking and say, look, here we are long. This is crossing back over. When it crosses back over, sell your trade. So you don't have to, you know how we normally wait with our stop loss? You can actually use the MACD and say, I'm going to sell my trade here and get out. Then you sell, you're out of the trade, it comes all the way back down, goes back, crosses back over, you get back in long. It's your long trade. You stay in long, stay in long. Now this is where it gets tricky. See this messing around over here? In this area, you don't really want to be selling out if you can help it, because you'll be selling out too early. And then that's when it's best to use the system or the strategy that we use for selling out of the markets. Because what I would look at on this one is, yes, it went extremely high, extremely overbought, probably a good idea to sell. On this one, it's only midway. It hasn't really gone that high. It's milling around in a very low area. For this one, I would use the trailing stop before I get out and take profit, because this is not telling me to sell. This is just messing around at a very low level. So when you get these spikes, these heavy areas here, you can start, okay, I'll sell, I'll take my profit. On these, kind of look at it in a different light and say, maybe I should hang on a wee bit and just see what happens. In this case, you would have sold. It wouldn't have been a bad thing. It would have gone down. It's milling around. It's ranging. Because when it's ranging, the MACD is very difficult to work with. So like I say, when you get a huge move like that, why does it do that? When you get a huge move like that, you take the long, you can sell and take your profit. But when you get these milling moves, no need to take your profit. Just move your stop losses up close and just follow it through and just see where it comes out. And that would have been another buy there, but you see it's like milling around and messing you around because it's ranging. And in a ranging market, the MACD is very difficult to trade with. But it's very useful in a trending market. When you've got a good trend like this US 500, you can get a good buy in. And if you get a heavy move like that, you can get a good sell and then back in a good buy. But sort of if it's not moving heavy, look at it. And that's what you must use these histograms, work out where the big ones are. And the big ones are ones that you can look at and say, well, if it reaches that height, I'm pretty sure I can possibly take some profit there and work according to that. So that's the MACD, guys. But don't forget, we work with price action. Price action is easy, as you know. We go to the day chart, we take our levels, our support and resistance levels, put them in and work off of that, because that's the best way to actually win with your trading. So that's the system. That's the MACD. Fine, isn't it? Wonderful. Don't trade with it. Just use your normal price action, support and resistance. But now you've got some more ammunition in your toolbox, more tools available to you to use if you ever feel that you want some confluence, or you want to check something out, or you want to see how at least you know how it works. Let's put it that way. Now you've got a good idea of how that works. But how do you approach the market in such a way that you can actually make a profit? Because the market's a 50-50 game. So that means, in all probability, if you take 10 trades, you'll lose 5, you'll win 5. But the effective situation is you want to win more on the 5 that you're winning and lose less on the 5 that you're losing. You don't want to be losing more and winning less, because that's why I say a win rate is meaningless, because people tell me they got win rates, they got an 80% win rate, but then they're making tiny little wins and gargantuanly huge losses. I mean, really, what's the point of a win rate? What you need is profitability. Now, I understand when you say you need a win rate in the sense of you need an edge in the market. And that's what the squiggly lines are for. What the squiggly lines are for is when you want to take a trade, you want to take what we call a high probability trade. So when you're taking the trade, you don't want to be taking a low probability trade. When you know it's going to lose, we'll trade that anyway, because we've got this psychological... No, it doesn't work like that, guys, really. You've got to look at it and say, that's a high probability that's happened in the past, and it's going to happen again in the future, and that's why we're taking this trade on those squiggly lines. That's what they're for. That's why I showed you the MACD system. That's why we trade with price action. That's why we trade with support and resistance on a daily basis. It's because we're looking at what to us is a high probability win. So that will give you said win rate. But the win rate is not going to make you money. The squiggly lines are not going to make you money. The systems are not going to make you money. What makes you money is you. And you'll say, but how do you do that really? Quite easy. And just follow this basic business plan. You don't even have to write it down, because it's all about the psychology of trading. You have to learn to lose. You have to learn to accept some loss. You can't win them all. Nobody can. Some think they can, but you can't. And if you listen to these guys that tell you you can turn $100 into $1 million, good luck, China. Ain't gonna happen. Now, what you do is you say, I've got a $100,000 account. You could have a $5,000 account. You could have a $50,000 account. Makes no difference to me. You could have $1 million account. We're just using a round figure. Then you decide what your risk factor is per trade. Now, in my case, I always recommend a 1% risk per trade. So for every single trade that you take on a $100,000 account, the risk would be $1,000, not $1,000. That's your risk. Now, do not change that risk amount on any given trade. All the trades need to be the same, because if they're not the same, then it's not going to work, is it? Then you're going to get different loss amounts, different win amounts, and you're going to be looking at win rates and all that rubbish. What you need to be doing is keeping the risk the same. So for every single trade, you take a $1,000 risk amount. Now, bear in mind that if you were to lose 10 trades in a row with that risk, then you lose 10% of your overall account, which is fair at the end of the day. It's not too bad. You can get that back. All I say is, now you've covered yourself, covered your risk. Now, the trick is, if the trade loses or goes into a loss, don't dollar cost average, don't panic, and don't move the stop loss further away. Coffee with Rob. We need some coffee. Always good. Always good. Keeps me going. So now, don't move the stop loss away. Don't dollar cost average. If it hits your stop loss, if it takes you $1,000, don't worry about it. Learn to lose it. Move on to the next trade with the knowledge that you're taking 10 trades, 20 trades, whatever, and you're going to win half of them. And the half that you win, you're going to make much more than $1,000 on, because the strategy is this. It moves into profit, and it goes about $700 into profit. Don't take the profit. Most of you will take the profit when it goes $50 into profit. What's the point, man? You've got a $2,000 target. Go $700 into profit. Take the stop loss up. Move it up to break even. And if it makes you feel more comfortable, move it 100, $200 into profit. If the stop loss comes back and happens to take you out at that, then the trade has cost you nothing. You've probably made $100, $200. It's a small, tiny profit, and you'll get a whole mishmash of those in your trading, and that'll give you this immense win rate. But at the end of the day, that's not what you're looking for. I mean, I actually look at that as a kind of a lost trade. It didn't work out. A trade that didn't work out. It's one of those trades that didn't do its thing. But at least I didn't lose anything. But now, if the trade carries on, goes through $1,000, goes up to 1,300, 1,400 in profit, get your finger off the sell button. I know you've got it on there. Oh, it'll sell that, I'm making a profit. Don't do that. That's the psychology. You see, that's the problem. Take the stop loss up, move it up to $1,000, move it up nicely. Now you're making a good profit, making 1-to-1. Should be quite happy with that. You would have taken it at $50. Now you're on 1,000. Now you watch it go up, goes up further. Let's say it starts hitting target. Now the first thing that most traders will do when that price hits target is click sell. And there's nothing wrong with that, because what's beyond that was never yours anyway. But what I do, so I take the stop loss and I move it right up behind at, say, $1,900 profit. If it comes back and takes it out, I'm happy. I made profit. I made just about full target. If it continues on north, which it can do, wow, what a trade. Because then you can just keep moving that stop loss up behind it. And now you're way above target. Anything that happens now is just bonus. You didn't get out of the trade too early. That's as simple as that strategy gets. And that's how you trade, guys. That's the psychology behind trading. That's the only way to trade. That's why I trade with price action. I don't use MACD. I don't use moving average crossovers or Fibonacci. I'm just showing you how to use it. And I'm doing a little series on that for you guys so that you know how to use it. But at the end of the day, the markets are 50-50. It really doesn't matter. That's why I just use price action. I look at the price. I know it's going to go that way. I take my trade and off she goes. Okay? Manage the risk correctly. You make your profit. Simple as that, really. So, come back for the live shows tomorrow. We'll talk a little bit further. It is the Santa time. It's Santa rally time. Hopefully the markets will go in that direction. Hopefully we'll get our standard Santa rally at this time of the year, which we normally do. Guys, I want to thank you for watching. And if you want to know more about price action, go and watch my last videos. It is on there. And now, obviously, over the Christmas period, I'm giving you these videos, which are about different systems that are out there that might be of interest to you. If you've got one that you want to know about, let me know. Someone did ask me for Bollinger Bands. I will get to that and we'll have a look at it. It's not one of my favorites, but we'll have a look at it and we'll give you a video on that as well. Thanks for watching, guys. Till the next one. Cheers, thanks, and bye.